It is officially over. The Federal Reserve didn't inject $22 billion into the banking system because the economy is healing. They didn't flood the overnight repo facility because lending conditions improved. They didn't trigger the largest single-week liquidity surge since March 2023 because everything is under control. They did it because the silver market just broke something critical in the global financial plumbing. And what broke cannot be fixed with speeches or forward guidance or carefully worded press releases. For months, we have been tracking the data. We have been watching the open interest climb. We have been monitoring the delivery demands at the COMEX. We have been calculating the leverage ratios at the bullion banks. And we have been saying one day the math will stop working. One day the paper promises will collide with physical reality so violently that the entire system will have to choose between honesty and survival. That day arrived last Tuesday. And the Federal Reserve just told you exactly what they chose. Ladies and gentlemen, this is Silver Revolution. While you were watching silver climb past 34.50, while you were calculating the gains in your stack, while you were reading headlines about inflation cooling and soft landings, something catastrophic was happening in the shadowy infrastructure that connects central banks to commercial banks to the futures exchanges where silver's price is supposedly discovered. The body has been found. The smoking gun is no longer hidden. And by the time I finish walking you through what happened in the last 72 hours, you will understand why the next 4 weeks will separate those who prepared from those who believed the narrative. Stop guessing. Stop speculating. The Federal Reserve Bank of New York just published the data, and the number is not a projection. It is not a forecast. It is a confession. $22 billion in emergency liquidity deployed in a single week. Stay with me. Let me show you exactly what landed on the Federal Reserve's H4.1 statistical release last Thursday afternoon, because the mainstream financial media spent exactly 11 minutes discussing it before pivoting back to whether the Fed will cut rates in June. And those 11 minutes were filled with the usual anesthetic language designed to make you look away. Temporary liquidity operations, standard year-end adjustments, routine repo facility usage. Here is what actually happened. Between Monday, March 24th and Thursday, March 27th, the Federal Reserve's overnight reverse repurchase agreement facility saw an inflow of $22.3 billion. That represents the largest single-week increase in emergency Fed lending since the regional banking crisis of March 2023, when Silicon Valley Bank collapsed and the entire financial system nearly seized. Now you need to understand what the repo facility actually is because the name is designed to bore you into submission. The reverse repo window is not where healthy banks go to optimize their balance sheets. It is not where prudent institutions manage routine liquidity needs. That happens in the federal funds market, where banks lend to each other based on trust and creditworthiness. The repo facility is the emergency room. It is the place you go when the normal channels have frozen. It is the place you go when your counterparties no longer trust you. It is the place you go when you have a mountain of U.S. Treasury collateral but zero cash, and you need dollars immediately to meet a margin call that cannot wait until tomorrow. If you are a bank tapping the Fed's repo window for $22 billion in a single week, you are not fine-tuning your asset allocation strategy. You are hemorrhaging. You are posting collateral to survive the next 24 hours. You are in a liquidity crisis that threatens your solvency. And here is the part that connects directly to silver. The timing is not coincidental. It is mechanical. On Monday, March 24th, silver opened in Asian trading at $33.85. By Wednesday's New York close, it had surged to $34.62, a move of nearly 2.3% in 48 hours. That might not sound dramatic to someone who trades tech stocks, but in the leverage-saturated world of commodity futures, a 2.3% move in 2 days on a metal where banks hold hundreds of millions of ounces in short positions creates billions of dollars in margin stress. Let me show you the math, because this is not speculation. This is arithmetic. A single COMEX silver futures contract represents 5,000 ounces. If a bank is short just 20,000 contracts, a conservative estimate for a major bullion bank, that represents 100 million ounces of exposure. When silver moves up by $1, that bank loses $100 million in mark-to-market value. When silver moves 0.77 in 2 days, that same bank just watched $77 million evaporate from its balance sheet. But losing money on paper is not what triggers the emergency. What triggers the emergency is the margin call. Every night, the COMEX clearinghouse recalculates the value of every open position. If the price moved against you, the clearinghouse does not wait for you to close the trade or hope the price comes back. The clearinghouse reaches into your account and demands cash to cover the risk right now. That demand is called variation margin, and it is non-negotiable. So, when silver ripped higher by nearly $1 in 48 hours, the clearinghouse sent out margin calls to every entity holding large short positions. And those entities had a choice: Post the cash immediately or have your positions forcibly liquidated, which would send the price of silver vertical and trigger a cascade that could break the exchange itself. The banks looked at their cash reserves, they looked at their liquid assets, and they realized they did not have enough, so they did what they always do. They gathered up their U.S. Treasury bonds, walked them over to the Federal Reserve, and said, "We need $22 billion in cash, and we need it now." The Fed did not ask why. The Fed does not ask why. The Fed's only job in that moment is to prevent a clearinghouse failure that could metastasize into a systemic crisis. So they printed the dollars, accepted the collateral, and kept the lights on for another day. But here is what that $22 billion transaction just told anyone paying attention. The bullion banks are illiquid. They are running their silver short positions on such thin margin buffers that a 2-day rally forces them to emergency borrow from the central bank. They are not in control, they are on life support. And life support patients do not win wars. They survive until the next crisis. Now let me take you underneath the surface, because if you do not understand the architecture of how silver is traded, you will misinterpret every price move for the rest of this cycle. And misinterpreting the price moves is exactly what the system needs you to do. Silver trades in two worlds. There is the paper world, where futures contracts, options, and ETF shares change hands electronically at the speed of algorithms. And there is the physical world, where actual metal moves in trucks, sits in vaults, and gets delivered to refineries and factories. The paper world is massive. The COMEX alone has open interest representing over 900 million ounces of silver on any given day. The SLV ETF holds approximately 450 million ounces in trust. Globally, the paper claims on silver dwarf the available physical supply by orders of magnitude. The physical world is tiny. Annual mining production is roughly 840 million ounces. Industrial demand consumes about 560 million ounces. Investment demand adds another 200 million ounces. The buffer, the excess metal available to absorb shocks, is shrinking every quarter. For decades, this two-tier system worked because nobody tested it. Futures traders rolled their contracts forward. ETF holders trusted the custodians. Industrial users bought hand-to-mouth. The paper price was accepted as the real price because challenging it required taking delivery, and taking delivery was expensive, slow, and operationally complex. But that equilibrium is breaking, and the $22 billion repo spike is the sound of the fracture widening. Here is the sequence of events that the data suggests occurred last week. Step 1. Silver rallies on a combination of industrial demand, inflation fears, and geopolitical uncertainty. The move is steady but accelerating. Algorithmic traders pile in. Retail investors start noticing. Momentum builds. Step 2. The bullion banks, which have been systematically short silver for years as part of their market making and hedging operations, suddenly face mark-to-market losses. Their short positions, sold at $30, at $32, at $33, are now underwater at $34.50. Step 3. The COMEX clearinghouse, using its automated risk models, calculates the new exposure and sends out variation margin calls. These are not polite requests. These are same-day demands for cash deposits to cover the risk of further price moves. Step 4. The banks attempt to meet the margin calls using their existing cash reserves, but their cash reserves are already stretched thin because they are simultaneously managing treasury positions, FX hedges, and derivative books across multiple asset classes. The cash is not there. Step 5. Unable to meet the margin call with existing liquidity, the banks face a binary choice. Either liquidate the short position, which means buying back millions of ounces in a rising market and potentially triggering a short squeeze that sends silver to $40 or beyond, or find emergency liquidity from the only source that can provide it instantly, the Federal Reserve. They chose the Fed. They chose survival over capitulation. And the Fed, seeing the systemic risk of a clearinghouse failure, provided the $22 billion without hesitation. Now, here is why this matters more than any single price move. The moment the Fed steps in to provide liquidity to prevent a commodity market failure, the dynamics of the trade change completely. Prior to this, the short sellers had the advantage. They had deeper pockets. They could outlast rallies. They could wait for sentiment to shift, for technical indicators to roll over, for retail traders to get bored and move on. But the moment they need the Federal Reserve to keep them solvent, they lose that advantage. Because the Fed can print dollars, but the Fed cannot print silver. Every dollar the Fed creates to bail out the shorts devalues the currency that silver is priced in. Every liquidity injection validates the exact thesis driving investors into hard assets. Every emergency repo operation is a billboard that says, the system is fragile, and we will sacrifice the currency to save the structure. This creates a doom loop that cannot be escaped through monetary policy. The banks need the price to go down to stop the bleeding. But to keep the banks alive, the Fed must print money. Printing money is inflationary. Inflation drives investors into silver. Silver goes up, the banks bleed more, the Fed prints more, the loop accelerates. This is not a theoretical construct. This is the exact pattern that broke the London gold pool in 1968, when central banks tried to suppress gold at $35 per ounce by selling physical reserves. They ran out of gold. The peg broke. Gold went to $850 within 12 years. We are watching the same movie, but this time the asset is silver. The mechanism is liquidity injections instead of reserve sales, and the timeline is compressed because information moves faster and leverage is higher. Now let's address the question that everyone is thinking, but few people ask out loud. Is this coordinated? Is this manipulation? Or is this just the natural mechanics of a broken market playing out in real time? The answer is, it does not matter, because the outcome is the same regardless of intent. Whether the bullion banks are deliberately suppressing silver as part of a coordinated scheme, or whether they are simply over-leveraged market makers trapped by their own risk models, the result is identical. They are short a massive amount of a physical asset that is in a structural deficit, and they are now dependent on the Federal Reserve to keep them solvent. But let me show you why the conspiracy versus incompetence debate misses the point. Look at the pattern of Fed interventions over the past 15 years. Every time a major financial institution faces a liquidity crisis, the Fed steps in. 2008, Lehman Brothers collapses. The Fed injects trillions. 2019, repo market seizes. The Fed restarts overnight lending. 2020, pandemic hits. The Fed goes to infinity. 2023, regional banks fail. The Fed creates emergency facilities. The pattern is clear. The Federal Reserve will do whatever it takes to prevent a clearinghouse failure or a bank run, even if it means debasing the currency, rewarding reckless risk-taking, and inflating asset bubbles. Now apply that pattern to the silver market. If the bullion banks face a margin call they cannot meet, and that margin call threatens to trigger a forced liquidation that could cascade into a clearinghouse crisis, what does the Fed do? Exactly what they did last week. They provide the liquidity. They accept the collateral. They prevent the immediate crisis, and they ignore the long-term consequences. But here is where the mechanics become conspiratorial, even without a conspiracy. Every time the Fed bails out the shorts, it gives them more ammunition to suppress the next rally. The $22 billion in liquidity allows the banks to post margin, avoid liquidation, and potentially even add to their short positions on the next dip. It allows them to fight another day, but it also guarantees that the eventual breaking point will be more violent, because every bailout increases the total leverage in the system. Every intervention delays the reckoning, and every delay allows the physical deficit to widen further. So, whether this is a deliberate scheme or an emergent property of a fragile system is irrelevant. The effect is the same. The can gets kicked down the road until the road ends, and there are signs the road is ending. Let's look at the physical market, because this is where the paper manipulation collides with material reality. The Shanghai Gold Exchange, which operates under different rules than the COMEX, has been pricing silver at a persistent premium to the New York spot price. As of last Wednesday, the Shanghai premium was approximately 0.85 per ounce. That might sound small, but in the world of precious metals arbitrage, an 0.85 gap is enormous. Normally, when such a gap opens, arbitrageurs step in. They buy silver in New York, ship it to Shanghai, and pocket the difference. That arbitrage should close the gap within days, but the gap is not closing. It is widening. Why? Because there is not enough available metal in New York to ship. The registered inventory at the COMEX, the metal that is actually available for delivery, has been declining for months. As of the most recent report, registered silver sits at approximately 42 million ounces, down from over 80 million ounces 2 years ago. At the same time, delivery demands are surging. In the December 2025 contract alone, over 18,000 contracts stood for delivery, representing 90 million ounces. The exchange managed to settle most of those through rolling contracts forward or cash settlements, but the stress on the system was visible. Now, connect the dots. The COMEX is running low on deliverable metal. The Shanghai market is pricing silver higher, signaling that physical demand in Asia is outstripping supply. And the bullion banks in New York just needed a $22 billion emergency loan to avoid a margin call. This is not a healthy market managing normal volatility. This is a market in the early stages of a supply crisis, where the paper price is being held down by leverage and intervention, while the physical price is trying to break free. And when the physical price finally does break free, the paper price will have no choice but to follow, because at some point the divergence becomes so wide that the arbitrage opportunity overwhelms the system's ability to suppress it. Now, let me walk you through what happens next if this dynamic continues, because understanding the cascade is how you avoid becoming a casualty of it. Stage 1 is where we are now. The Fed provides emergency liquidity to prevent an immediate crisis. The banks use that liquidity to meet margin calls. The price stabilizes or even dips as the immediate pressure is relieved. Mainstream media reports that the spike was just speculation and the market is normalizing. This is the false calm. This is the phase where retail investors who do not understand the mechanics get shaken out. They see the price dip after a strong rally, they read the headlines saying the move is over, and they sell. They transfer their physical metal or their futures contracts to stronger hands at a discount. Do not be that person. Stage 2 begins when the next catalyst hits. It could be another geopolitical event. It could be a major industrial buyer announcing a strategic stockpile. It could be a sovereign wealth fund taking a large position. It could be a technical breakout that triggers momentum algorithms. Whatever the catalyst, the price starts rising again. And this time, the banks are even more leveraged than before because they used the Fed's $22 billion to stay in the game rather than to reduce their exposure. So the margin calls come again. But this time, the number is bigger. Maybe it is $30 billion, maybe it is $40 billion. The Fed provides the liquidity again, but now the pattern is visible. Now the market starts to realize that the Fed is effectively underwriting the silver shorts, and that realization changes behavior. Sophisticated investors recognize that the Fed's intervention is not a sign of strength. It is a sign of terminal fragility. They start allocating more capital to silver, not less. They start taking delivery instead of rolling contracts. They start pulling metal out of ETFs and into private vaults. This accelerates the physical drain. Stage 3 is where the system breaks. The banks need another bailout, but this time the amount required is so large that it cannot be hidden in a routine H-4-1 release. It is $100 billion. It is $200 billion. It is a number that forces a public acknowledgement. At this point, one of three things happens. Option 1. The Fed openly announces a new facility specifically designed to provide liquidity to commodity market participants. This would be unprecedented, and it would signal to the entire world that the U.S. financial system is so fragile that a short squeeze in silver threatens systemic stability. The credibility damage would be catastrophic, and it would accelerate the flight from dollar-denominated assets. Option 2. The COMEX declares force majeure and settles outstanding contracts in cash rather than physical delivery. This would break the link between paper and physical pricing permanently. The paper market would collapse in credibility and the physical market would explode in price. You would see silver trading at $50 on the COMEX and $150 in the private market simultaneously. Option 3. The banks capitulate. They cover their short positions, regardless of the price. This would trigger the largest short squeeze in commodity market history. Silver would go vertical, it would hit $50, then $75, then $100, potentially in a matter of weeks. All three options result in a much higher silver price. The only question is which path the system takes to get there. And here is the critical insight that most people miss. The Federal Reserve's $22 billion intervention last week just made all three options more likely, not less. By preventing the banks from being forced to cover their shorts at $34, the Fed allowed the short position to grow even larger. By providing liquidity instead of forcing liquidation, the Fed guaranteed that the eventual reckoning will be more severe. They did not solve the problem. They made it worse while buying time. And time in this context is the enemy of the dollar and the friend of silver holders. Now, I want to step back from the charts and the data and talk about what this means for real people. Because the numbers I have been sharing with you are not abstractions. They are descriptions of pressure building in the real economy. There is a pension fund manager in Ohio right now who is responsible for the retirement security of 23,000 teachers. That manager has a mandate to preserve capital and generate income. For years, the safe play was U.S. Treasuries and investment-grade corporate bonds. But with the Fed injecting $22 billion in emergency liquidity to bail out silver shorts, that manager is now asking a very uncomfortable question. If the Federal Reserve is willing to debase the currency to prevent a commodity market failure, what does that mean for the purchasing power of the bonds I am holding? There is a family in Arizona whose entire savings is in a 401k invested in a target date retirement fund. They do not watch financial news. They do not read Federal Reserve reports. They trust that the system will protect them if they follow the rules. But the rules are changing underneath them, and they will not know it until their retirement account buys 30% less than they planned because the currency was sacrificed to save the banks. There is a recent college graduate in North Carolina carrying $78,000 in student loan debt, working 2 jobs, watching grocery prices rise every month, and being told by every financial advisor that gold and silver are speculative and risky. Meanwhile, the institutions managing trillions of dollars are quietly accumulating physical metal, taking delivery, and positioning for the exact crisis they are telling the public will not happen. This is not a fair fight. This is not a level playing field. The information asymmetry between institutional investors and ordinary people is not accidental. It is structural. The $22 billion repo spike is public information. It is published on the Federal Reserve's website, but it is buried in statistical releases that require a graduate degree in finance to interpret. It is reported in language designed to sound routine and boring. The goal is not to inform you. The goal is to inform you in a way that ensures you do not act on the information, but you are here, watching Silver Revolution. You are taking the time to understand the mechanics. You are connecting the dots that the mainstream financial media refuses to connect. That gives you an edge. Not a guarantee, but an edge. And in a market where the majority of participants are operating on outdated assumptions and manipulated narratives, an edge is everything. So here's the conclusion that the data forces us to reach. The Federal Reserve's $22 billion liquidity injection last week was not a routine operation. It was an emergency intervention to prevent a silver short squeeze from triggering a clearinghouse crisis. The bullion banks are not in control of the silver market. They are trapped in positions they cannot exit without causing the exact systemic event the Fed is trying to prevent. The paper price of silver is being held down by leverage, intervention, and liquidity injections. But the physical market is tightening, inventories are draining, premiums are widening, delivery demands are surging. This divergence cannot persist indefinitely. At some point, the physical reality will overwhelm the paper manipulation. And when it does, the price adjustment will not be gradual. It will be violent. The Federal Reserve has a binary choice in that moment. Choice A, let the market clear. Allow the banks who mismanage their risk to fail. Allow the price of silver to rise to whatever level is necessary to balance supply and demand. Accept the short-term pain of a clearinghouse crisis in exchange for long-term market integrity. Choice B, print more money, provide more liquidity. Bail out the banks again. Preserve the structure of the financial system at the cost of destroying the purchasing power of the currency. Based on 15 years of documented behavior, the Fed will choose choice B. They will always choose choice B, because central banks do not exist to protect the currency. They exist to protect the banks. But here's the doom loop they cannot escape. Every time they choose to print money to bail out the silver shorts, they validate the thesis that is driving investors into silver in the first place. They prove that the currency is being managed for the benefit of financial institutions, not for the preservation of purchasing power. And every validation accelerates the flight from paper into physical assets. So the more they intervene, the higher the ultimate price of silver must go to ration the dwindling supply. This is not a prediction. This is math. If the Fed prints $22 billion this week to prevent a crisis at $34 silver, how much will they need to print when silver hits $40? How much at $50? How much at $75? And at what point does the printing itself become the crisis that the printing was supposed to prevent? We are entering the phase of the cycle where those questions stop being theoretical and start being urgent. The $22 billion was the warning shot. It was the Fed telling you, in the language of central banking, that the system is more fragile than the headlines suggest. The banks are leveraged to the breaking point. The physical market is tightening, and the only tool the Fed has left is the printing press. That is not a recipe for currency stability. That is a recipe for a monetary reset, where hard assets reprice violently against fiat claims. And silver, as the most undervalued strategic metal with the deepest structural deficit, is positioned at the center of that repricing event. So, what is the roadmap for the next 4 to 8 weeks? How do you navigate a market where the rules are changing in real time and the referee is actively intervening to protect one side? First, understand that volatility is not your enemy. Volatility is the price of being in the trade that matters. The bullion banks, armed with their fresh Fed liquidity, will attempt to engineer pullbacks. They will use the cash to short the market on technical breakdowns. They will try to trigger stop losses. They will try to create the psychological conditions that make you doubt your thesis. Do not let them. Every violent pullback in a structurally tight market is a gift. It is an opportunity to acquire physical metal at a discount to where the price will be in 6 months. The banks are not smashing the price because they are winning. They are smashing the price because they are desperate. Desperate players make mistakes, and their mistakes create opportunities. Second, watch the physical indicators, not the paper price. The paper price can be manipulated. It can be pushed around by margin hikes, by algorithmic selling, by Fed interventions. But the physical market does not lie. Watch the premiums. If the paper price drops but premiums on physical coins and bars hold steady or widen, the physical market is telling you the drop is fake. Watch the delivery data. If the number of contracts standing for delivery continues to increase, the pressure on the system is building, not easing. Watch the Shanghai premium. If the gap between Shanghai and New York prices continues to widen, it means physical metal is flowing east and not coming back. Watch the COMEX registered inventory. If it continues to decline, the exchange is running out of deliverable metal regardless of what the screen price says. These indicators are harder to manipulate than the futures price. They are slower to move, but they are more reliable. Third, prepare for the unobtainium phase. We are approaching the point where physical silver becomes difficult to acquire at any price. The dealers are already experiencing delays. Premiums are already elevated. Mints are already rationing production. When the next surge hits, and it will hit, the retail market could freeze entirely. The buy button could disappear. Not because silver is unavailable in the world, but because the retail distribution network cannot source it fast enough to meet demand. If you are waiting for a dip to start your position, you are playing Russian roulette with a fully loaded gun. The risk is not that you buy too high, the risk is that you cannot buy at all. Fourth, do not sell your metal for fiat currency that is being printed to bail out your adversaries. The entire point of holding silver is to protect yourself from currency debasement. If you sell silver for dollars the moment the price rises, you are defeating the purpose. When silver hits $50, do not sell it for dollars. When it hits $75, do not sell it for dollars. When it hits $100, do not sell it for dollars. If you need liquidity, borrow against it. Use it as collateral. Trade it for productive assets, for land, for a business, for something real, but do not trade it back into the burning building of the fiat system. Fifth, understand the difference between trading and positioning. Trading is about timing entries and exits to maximize short-term profit. Positioning is about acquiring an asset that you believe will reprice dramatically over the medium to long term and holding it through volatility. If you are trading silver, you will get shaken out. The volatility is designed to shake out traders. The margin hikes, the Fed interventions, the coordinated smashes are all designed to create the emotional conditions that force traders to sell. But if you are positioning, if you understand that you are holding a strategic metal in a structural deficit during a period of unprecedented monetary expansion, then the volatility is just noise. Position for the reprice. Do not trade the noise. Let me bring this full circle. The $22 billion liquidity surge that hit the Federal Reserve's balance sheet last week was not a minor technical event. It was a flare shot into the night sky, revealing the true condition of the silver market. The bullion banks are not managing risk. They are managing survival. They are dependent on the Federal Reserve to keep them solvent through margin calls that they cannot meet with their own capital. The Federal Reserve is not protecting the currency. It is protecting the structure of the banking system, even if that means debasing the dollar to do it. The paper price of silver is being suppressed by leverage and intervention, but the physical market is tightening at an accelerating rate. And the gap between paper and physical is widening to the point where it can no longer be ignored. We have crossed the Rubicon. The point of no return was not a dramatic announcement or a policy change. It was a $22 billion wire transfer on a Tuesday morning that most people never heard about. But that transfer just guaranteed that the eventual resolution of the silver market will be far more violent than it would have been if the market had been allowed to clear naturally. The banks have been given more time. But time is not on their side. Every day that passes, the physical deficit widens. Every intervention, the credibility of the paper market erodes. Every bailout, the currency loses value. And on the other side of this equation, you have millions of ordinary people who are starting to wake up to the fact that the system is rigged against them. They are starting to realize that the safe assets they were told to hold are being diluted to save institutions that took reckless risks. They are starting to move into hard assets. And silver, with its tiny market size and massive industrial demand, is the obvious target. When that wave of capital arrives, it will not care about technical support levels or moving averages. It will not wait for a pullback. It will buy at any price because the alternative is staying in a currency that is being debased by design. The $22 billion was the confession. The Fed just told you they will do whatever it takes to prevent the banks from failing on a silver short. And by telling you that, they just told you that silver is the trade that the system cannot afford to let succeed, which means it is exactly the trade you should be in. I am Silver Revolution. The liquidity surge has confirmed what we have been saying for months. The paper market is breaking, the physical market is tightening, and the Federal Reserve is now the counterparty. You have the data, you have the framework, you have the roadmap. The ghost week is over. The institutions are back. And the next leg of this move is not going to be driven by retail speculation. It is going to be driven by forced covering, by delivery demands, and by the mathematical reality that you cannot print silver. If this video connected dots that you had not seen before, if it gave you a framework to understand what is actually happening beneath the headlines, then leave a comment right now. Tell me, do you think the Fed's $22 billion injection was a one-time event, or is this the beginning of a sustained liquidity cycle to support the silver shorts? Not a generic comment, a real answer. Because the conversation happening in the comments of Silver Revolution is where ordinary investors start thinking like informed investors. And if you know someone who has savings in the market, who is holding dollars, who believes the system is stable, share this video with them tonight. Not because it will make them comfortable, because they deserve to see the data before the next crisis hits, not after. Subscribe to Silver Revolution. Hit the notification bell, because the next $30 billion liquidity spike is not going to come with a warning. It is going to come with a price move that leaves the unprepared behind. This is for education and discussion only, not personal financial advice. I am showing you how to think through the data so you can make your own decisions with your own risk and your own capital. The Silver Revolution has begun. The Fed just confirmed it with $22 billion. The only question now is whether you are positioned for what comes next, or whether you are still waiting for permission from the same institutions that are bleeding. See you on the other side.